All right, let's talk about something that sounds, well, kind of impossible. What if you could legally just wipe out a six-figure tax bill? Today, we're digging into an article that lays out a very specific playbook for doing exactly that, all using commercial real estate. It sounds almost too good to be true, so let's unpack how this thing is supposed to work. So picture this. It's December, you're trying to wrap up the year, and then bam, you get hit with the news that you owe the IRS $182,000. I mean, that's a staggering amount of money. And this isn't some hypothetical. It's the real-life tax bomb that kicked off this entire strategy we're going to explore. So what do you even do in that situation? Well, the author's accountant gave this almost shockingly simple advice. Just buy a building, run something called a cost-seg, and the problem goes away. It sounds way too easy, right? But as we're about to see, that one little sentence unlocks a really powerful combo of real estate and a specific tax code loophole.
This whole situation sets the stage for what the author calls their 2024 scramble. And when they say scramble, they mean it. We're talking about a frantic, high-stakes, last-minute dash against the clock to solve this massive financial problem before the ball drops on New Year's Eve. Not exactly a well-thought-out plan.
And here's the wild part. It worked. That $182,000 tax bill didn't just get smaller, it completely vanished. They actually ended up getting a refund. But the author's really clear that the stress of that whole scramble was the real lesson here. It became the motivation to build a proactive playbook so they would never, ever have to panic like that again.
So, what changed? How do you go from a mad dash to a repeatable strategy? Well, it all comes down to a specific piece of legislation that's described in the source material, one that the author calls a total game changer for real estate investors. Now, according to the article we're looking at, this entire 2026 playbook is built on a law it calls the One Big Beautiful Bill Act, which it says was signed into law on July 4th, 2025. This act, as they describe it, fundamentally changed a really important tax incentive. And that incentive is called 100% bonus depreciation. So, in simple terms, it lets a business deduct the entire cost of certain assets right away in year one, instead of slowly writing them off over decades. The big deal, according to the source, is that this new law supposedly made that 100% rate permanent, getting rid of the old system where it was set to phase out over time. But here's the thing. That law is only one part of the puzzle. The real magic, what makes this so powerful, is how it gets combined with another real estate accounting tool to basically multiply its effect. Let's see how these two work together. This slide nails the core idea. Think of it like this. Normally, you depreciate a building super slowly, like the turtle on the left. But a cost segregation study is like a special engineering report that, for tax purposes, takes the building apart. It says, hey, the carpeting, the light fixtures, the landscaping, all that stuff wears out way faster than the foundation. This lets you depreciate those parts much, much faster, turning your reductions into the rocket ship on the right. And this is where it just gets insane. Look at the numbers. The standard slow way gives you a $69,000 deduction. Okay, not bad. But when you combine cost segregation with that 100% bonus depreciation we just talked about, the deduction explodes to over $750,000. The tax savings, they jump from under 20 grand to over $250,000. It's not even in the same ballpark. Let's just pause on that number. Over $250,000 in tax savings in the first year alone. As the article points out, that is more than enough to fund the down payment on the next investment property. You can see how this becomes a powerful wealth-building engine, one deal feeding the next. Okay, so you've got this tax-erasing superpower unlocked. Now what? Let's get into the forward-looking playbook, which takes this power and aims it like a laser at a specific type of property in a very specific market. So for 2026, the plan is to switch things up. Instead of just using their own cash, the author is planning to use syndication, which is just a fancy word for pooling money from other investors. They act as the general partner, the one running the show, which allows them to control the deal and keep those massive tax deductions for themselves. Meanwhile, the investors get a nice, steady return on their money. It's designed to be a win-win. So why Indianapolis industrial properties? Well, this forecast from the source gives us the clues. They're seeing stable cap rates, which is just a measure of your return on investment. They're predicting solid rent growth. And, maybe most importantly, the vacancy rate is expected to tighten, which means fewer empty buildings and more power for landlords to raise rents. The author sees 2026 as the perfect window to jump in. And the plan gets even more granular. It's not just Indianapolis. It's these three specific submarkets. Each one is targeted for a different reason. You've got West Hendricks for the big properties you can fix up, the East for brand new buildings that just need tenants, and the Northwest for smaller, high-demand industrial spaces that are already making money. All right, let's get to the final section and see how all of this, the tax strategy, the market analysis, gets turned into a concrete year-long action plan. This is where it goes from a cool idea to a step-by-step process.
And this timeline is what the author calls the never scramble again fortress. You can see how proactive it is. Q1 isn't about panic, it's about looking ahead, projecting the next tax bill, and already scouting for deals. By Q3, the property's already under contract and the cost-seg engineer is hired. It's a completely methodical process designed to have every piece in place months before that December deadline ever hits.
That there's one last, absolutely critical piece to this whole thing. To use these huge paper losses from real estate to wipe out taxes from a regular, high-paying W-2 day job, the author needs to qualify as a real estate professional in the eyes of the IRS. And that means proving they spend a ton of time, over 750 hours a year, on their real estate business. Without that specific tax status, this strategy just doesn't work for high-income earners. So there you have it, a really detailed playbook for turning what could be a massive tax problem into a wealth-building machine. It's this blend of deep tax code knowledge and very specific market analysis, which kind of leaves us with one final thought. What's the biggest lesson here for your own financial world? Is it the power of being proactive, the importance of knowing your niche, or something else entirely?